You're listening to The Weekly Edge, your straight-talking guide from industry experts on what's really moving the fixed income markets, here in Australia and around the globe. Brought to you by Gilt Investments. The Weekly Edge is your go-to podcast for sharp, actionable insights into the forces driving bond markets. Each week, your hosts Alastair Healey and Richard Brennan take you on a fun and insightful romp through the financial markets. With their no-nonsense style and deep experience, they help you cut through the noise. Alastair's deep market smarts and Rich's trend-driven mindset make for the kind of conversation that keeps investors sharp, and always one step ahead. Quick hits, smart takes, real perspective. Let's dive in.
G'day, and welcome back to the Weekly Edge. It's Thursday, May the 1st, and if last week felt messy, this week's looking like someone tried to fix it with Band-Aids. Tariffs are back in fashion, the US dollar's losing weight faster than the crash diet, and markets, well, they're faking confidence about as well as a bad poker player. So, how are you this morning, Al? And what are your general thoughts for the week?
Richo, I'm as strong as 10 men, mate. Feel fantastic, and it's been a great week. I'd have to agree, I think. We're now in that a week's gone past. I think my general feelings at the moment, because you could quite easily feel like it's all gone a bit quiet. But to me, I think that's the market getting over the initial shock, because you had that week where there was extreme volatility. That'll affect anybody, anywhere. Then you've got to wait for all these things to flow through to the market. So you go from an open market to a tariff market. That's going to have some effects, but you're not going to see it straight away. So you have to wait for it to flow through.
Bit like an earthquake, the initial tremor and then a bit of quiet, then a tremor comes back again.
Absolutely, like a tsunami, I guess. Then the other thing is Trump keeps sending different messages. So there's a few people thinking that maybe he might soften and come back down and change again. So everyone's waiting for that. And then you've got to really keep an eye on nations around the world who are all getting affected, because they're all reacting differently. So all of that together has made the market sit and look and wonder which way to go.
So perfect, listeners, grab your coffee or something stronger while Al and I get into this week's highlights, starting with the latest episode of Tariffs Gone Wild. So Al, big headline, Trump's new and improved tariffs, 120% to 145%, which have about as much subtlety as a sledgehammer. Money managers are about as enthusiastic as a cat at bath time when it comes to rushing into China. And the US dollar, let's just say it's having a bad hair day, down almost 7% this year as tariffs tax their own imports into a recession. While the dollar's sliding down the stairs, safe havens like the yen and the Swiss franc are quietly picking up the slack. The pound's even decided it wants to be relevant again, jumping to a 3-year high. Meanwhile, US manufacturing is limping along and productivity's looking like it needs a nap. For fixed income, well, lower dollar plus tariff inflation equals a mix of falling confidence and rising yield pressures. Investors are trying to figure out whether to hug their bonds or run screaming from them. Al, your thoughts?
Whew, there's a lot to go through there. Basically, it's the same as we were saying last week. Where do you put your investments? The world has just been scrambled. If Trump keeps tariffs, they're going to affect everybody. And not only that, if you look at the two biggest economies in the world, America is the biggest consuming economy in the world, and China is the biggest manufacturing economy in the world. And tariffs in the middle of them basically affects both of them. So that's going to turn everything upside down for sure. The US dollar has had mixed reactions. Whilst I know you're saying it's going down, really, the currency levels, if you look at the US dollar against the euro, it's gone down, but it's pretty much on par with the pound. It's gone up against the Aussie. It's gone down against the yen. It's gone up with both the Chinese currencies, the internal one and the external one. So really, you can't make a big statement that the US dollar's gone down unless you know precisely which currency you're measuring it against, because it's all over the place at the moment. With the lower US dollar, imports are expensive anyway, so that sort of helps them on that side. Currencies basically are free, so they set their own levels. And it's not, currencies aren't necessarily influenced by tariffs. There is things like liquidity, the volume, the biggest, currencies with the biggest market to be able to take the liquidity. You've got to look at taxes. You've got to look at interest rates, not just on one side, not just the US dollar. You also got to look at the yen and the pound and the euro and any other currency you're going to put your money across to. So you've got to look at both sides. The market is definitely scrambling. The part of that scramble is, if you look at what people are doing, if you're looking at businesses, importers and exporters, they've got to now make decisions based on currencies. Do they buy, if they're an importer from, say, China, do they buy Chinese yuan now, or do they wait? If they think the US dollar is going to go down further, they might buy it straight away. So as companies, whether they're importers and exporters, tariffs are going to affect both of them, and they've got to make these decisions. Do they wait or they go in straight away? The same with fund managers. Fund managers are constantly looking at, and you've got this humongous wad of money that goes around the world trying to look for investments. Well, they have to make decisions as well. They buy a currency. These days, if you hedge your currencies, it takes away the differential in interest rates. So there's no point in hedging. So you've then got to buy currencies and run the exposure to those currencies. So they have the same decisions. Are rates going to go up in America because they've just put tariffs on everything? And if rates go up in America, should you wait before you buy the US dollar? So those decisions are incredibly hard to make whilst you're managing a book and trying to get returns for investors. So one of the points there where you've got lower dollar and tariff inflation, a weird mix, investors trying to figure out whether they should be hugging their bonds or run screaming. For me, you should never be out of bonds. At the end of the day, there's three asset classes. It's really, depending on what risk you want to take, you change your percentages in those three asset classes. With bonds are a safe haven, and they're the only safe haven the world has got, really, apart from gold and a few other bits and pieces, but bonds are the where to go. If you don't want to get it wrong with bonds, then don't go long. So with bonds, you stay in the asset class, you just go short, not long. And yes, you could say it's a weird mix, but it's just the market. It's weird, I guess, because the market for 20 to 30 years has been an open, free tariff zone sort of area. There's been no tariffs, so it's free trade zones. So we've operated in that market. Now it's been just turned upside down. So yes, it looks a bit weird, but it's really just the market desperately trying to work out where they should be. Companies are trying to work out currency positions, and some of those big monopolies have got huge currency positions. They've got to either hedge or take a position. And fund managers are doing the same. So that makes it, very strange and very volatile.
Right, Al. So let's move on. We're seeing cracks in private credit. These are loans made directly by private lenders rather than banks. And it appears the party may have gone on a little too long. Over 40% of borrowers in direct lending deals are now cash flow negative. The private credit boom was built on some pretty optimistic assumptions, but with economic conditions tightening, the cracks are now showing. And it turns out many of these borrowers are in far worse shape than anyone wanted to admit. And that's starting to look like a growing problem for lenders. And as for consumer sentiment, well, it's on its way down to the basement. It's just posted its biggest drop since 1990. And apparently people don't feel great when prices are up, layoffs are rising, and the government's economic plan involves tweeting at central bankers. But despite these omens, markets are still pretending everything's fine. Kind of like a restaurant that's clearly on fire, but keeps seating new customers and asking how they'd like their steak. And in fixed income, when borrowers can't pay, credit spreads don't stay quiet for long. Combine falling consumer confidence with falling free cash flow, and you've got the makings of a messy second half to 2025, don't you, Al?
Yeah, you do, definitely. Unfortunately, when I think it was a perfect storm a little bit, where the world has operated in an environment where you've had three asset classes that have just continued to improve. So stock markets have constantly gone up. property values have constantly gone up and interest rates have constantly gone down. And then along comes COVID and shuts everything down. So pension funds and fund managers globally then scramble to get returns, because most of them have made humongous promises to their members and have to cover those promises. And I think I've read somewhere along the line that most pension funds and fund managers or super funds have to get somewhere around 6 to 7% in order to cover all their promises. So in that environment, when you've got COVID and cash rate got down as low as 0.1, in fact, in Europe, the yield curve was negative all the way out, then it's very hard to find returns. Unfortunately, they then all changed their policies and headed into private equity. And now we've got this issue where you've just mentioned, over 40% of borrowers in direct lending deals are now cash flow negative. Banks are banks for a reason, and the authorities regulate the banks for a reason, because if they get into trouble, then everyone gets into trouble. But for some strange reason, when people are chasing yields, they tend to avoid the banks and go around the banks and think they can lend money into credit better than banks can. But they can't. They're still, you lend money to someone else, you've got a credit issue, you've got a credit problem. You have to be able to analyze that credit and have the skills and the ability to do that. But not only that, you need to manage your whole exposure and the downside, and what you do if you're in trouble. You've got to manage all that, which is, it's easy when the rates are going up and asset prices are going up. It's dead easy. You can lend money to anybody. But when it starts going down, and if you do have any security against your loan, and the security you've got is suddenly underneath the amount of money you've lent, people lose their jobs, all those sort of things start to kick in. With banks, they've got capital that's sitting on the fence that they can tap into to shore up their balance sheets. But, super funds and pension funds and private high net worth wealthy people who lend their money out to people directly don't have all that ability. So it doesn't surprise me. It will definitely be an issue. If interest rates go up, if we have inflation and rates go up, then you're going to see some more pain there for sure.
Yeah. All right, Al. So let's get back to the land of down under. So here in Australia, things look less awful. For now, bond yields are holding around 4.2%. Equity markets are drifting higher, like they forgot to check the weather forecast. But APRA is issuing subtle warnings. Banks are working overtime for deposits, and there's some chatter that Australia could lose its AAA rating. Spoiler alert, that's not great. So, Al, what are the ramifications of all of this?
We're never the catalyst. Australia is too small a market, and we don't manufacture too much, so we bring in manufactured items. We dig up raw materials, we farm, we send it all offshore. The money we get, we then go and buy manufactured items. So
we float along for the ride. We're
never a catalyst, so we never create inflation, we always import it. So that's always an issue. So, and we borrow a lot of money. Of our $1 trillion at federal government levels, there's about 400 billion that we've borrowed from overseas. So when S&P makes a comment about AAA rating, then you don't ignore it, even if you are heading into an election. So for me, just to give you an example of how important it is, if you go back prior to 2008, when America was AAA rated and Australia was AAA rated, and you would think if you had the exactly same rating, you would be borrowing money at the same level. Well, that's not the case. It's a little bit like the corner store competing with Westfield Plaza. We had to pay, when we were exactly the same rating as the Americans, we still had to pay 1.5% over their cash rate. So if their cash rate was 5, we had to pay 6.5%. We've survived and been able to get away with things because we're still AAA rated, whereas the US has gone down to AA+. So they're one notch underneath us. So if we lose our credit rating, that means we go back to being on par with the US. All fund managers have policies that they're allowed to put money into a AAA rated investment. So if we lose that AAA rated level, then it's mandatory for those funds to take their money out of Australia, or they reallocate their proportion of AA+. But if our yields are really low, we won't even get much of that, allocation to AA+. They'll have to adjust straight away. But if you go back to the American analogy, their cash rate at the moment is 4.75. If we lose our rating right now, that means our cash rate needs to go to 6.25, pretty much overnight. So that, we're talking right now, the market's saying we've got 6 rate cuts or something, or 4, depending on which major bank you're talking to. It's anywhere between 4 to 6 rate cuts in the next 12 months. Meanwhile, S&P has told Australia that if you keep spending money like you are at the moment, we'll have to downgrade you. And if we get downgraded, then there's no way we're going to be getting rate cuts. Or if we get rate cuts, then we'll have to it'll be a greater effect after that, because we'll be at a lower bottom sort of thing, a lower level to push back up over 1.5 over the US will be even, more dramatic.
Makes you think about getting your home mortgage, doesn't it?
Yeah, well, just got to keep an eye on it, because it's not there yet. We're sitting, as the question said, we're sitting, waiting and watching and looking, because we're a small market. We react and we wait for it to flow through. It takes a while for it to flow through, because everyone's got to adjust. We've got to, we're not on the radar with the big markets around the world. We're way down the pecking order, so we sit and wait.
All right, Al. So let's wrap it up. So in summary this week, tariffs are back and they're bringing friends. The US dollar's staging a disappearing act. Credit markets and consumers are cracking, but don't worry, everyone's still smiling for the cameras. And Australia's steady, but keep the life jackets handy. That wouldn't hurt. And the moral of the story, hope is not a strategy.
Exactly right. Couldn't have said it better myself. No, absolutely. You've got to be on your toes. You've got to keep an eye on everything. And it's not that hard. There's a lot of articles that, we get swamped with a lot of information. You just got to keep an eye on things. Also, question everything. People have conflicted views on stuff. Major banks, they love rates going down. They lend more money. So you have to wonder whether they're being conflicted or influenced by their own balance sheets. So keep an open mind, keep an eye on what's going on, and be ready to move is really key. And for me, with this sort of uncertainty in the market and volatility in the market, nobody can predict that. So you'd really have to be cautious and wait for it to settle down, which could be some time yet.
All right. Well, that's a wrap, everyone. Thanks for joining us on The Weekly Edge. And from all of us at Gilt, keep your sarcasm sharp and we'll catch you next week.
Absolutely. Thank you very much, Richo.
Thanks, Al.
Thanks for tuning in to The Weekly Edge. At Gilt Investments, we're here to help you navigate the fixed income markets with clarity and confidence. As an Australian fixed income brokerage licensed to advise and deal in fixed income securities, our experienced team is ready to help you reach your investment objectives. We hope you enjoyed this week's Edge and that it helped keep you in the loop and ahead of the curve. Until next time, stay sharp, stay focused, and we'll see you on the next episode of The Weekly Edge.